What's up everyone, and welcome back to the channel. Let's break down a wild week in the markets as we close out Friday, January 20th. First, let's talk about fear. The VIX, our favorite fear gauge, has spiked. It shot up from the mid-teens all the way to the 19 to 20 range. What's driving this? A cocktail of geopolitical noise, uncertainty around the Fed's next move, and renewed threats of tariffs. When the VIX spikes, it means investors are getting nervous, but it also signals opportunity is brewing. Now for the headline story, gold. Gold has absolutely smashed through its all-time highs, trading between $4,720 and $4,733 an ounce. That's a 1-2-3% jump just recently, continuing its massive 72% rally from last year. This is a classic safe haven rush. Investors are piling into gold to protect against inflation, ongoing de-dollarization trends, and just general global tension. At the same time, the US dollar index, the DXY, has slipped down to the 98.4 range, which continues to be a tailwind for international stocks. Speaking of which, VIX US, the total international stock ETF, is holding firm above $78. Posting solid gains as money rotates out of the US and into global markets. And for our crypto watchers, Ether is consolidating in that $3,100 to $3,200 range after its recent bounce. So what's the big picture here? The long-term bullish structure is still very much intact. Top analysts like Tom Lee are still targeting an S&P 500 level of 7,700 by the end of this year. They're expecting a powerful second-half rally driven by AI advancements, productivity gains, and more clarity on economic policy. But, and this is a big but, the short-term path is going to be choppy. We need to be prepared for more volatility. This VIX spike suggests we're re-entering what Tom Lee calls the depression phase of his Joy Depression rally cycle. This means we could see a significant mid-year pullback, maybe 15 to 20%. Which would take the S&P 500 down to the 5,900 to 6,200 zone. Now, the key here is not to panic. If 2025 taught us anything, it's that these dips are buying opportunities, not reasons to sell everything. Volatility is where you find the best entry points. So, how should we position our portfolios for this environment? Let's talk strategy. First, international exposure is key. I'm allocating around 35 to 40% to something like VIX US. It acts as a great hedge and benefits directly from a weaker dollar. Next, gold. With it hitting record highs, it's no longer just a defensive play. It's a core holding. I've ramped up my allocation to about 20 to 25% in an ETF like GLD. It's a must-have right now. For our core U.S. exposure, I'm at 25 to 35% in broad market ETFs like SPY or VU. The strategy here is simple. Buy the dips aggressively. When the market panics, we get ready to shop. Technology, tracked by VGT, is a sector I'm currently underweight at 10 to 20%. Why? I'm waiting for better prices. ILL starts scaling in on 5 to 10% pullbacks to capture that long-term AI rebound story. For crypto, I'm holding a smaller 5 to 10% allocation in ETH, looking to add near support levels for that potential explosive upside. And finally, cash is king in a volatile market. I'm holding about 15 to 20% in cash or short-term T-bills, which are yielding around 3.5%. This is our dry powder, ready to deploy when those buying opportunities appear. So, what's the game plan? Hold your core positions. Don't make any rash moves. Start buying the weakness in tiered entries. For VGT and SPY, maybe a small probe buy on a 3 to 5% dip, a bigger add-on an 8 to 10% pullback, and get really aggressive if we see a 15% or more correction. The bottom line is this. The markets are shaking, but the long-term bull is alive and well. Gold and international stocks are shining. And volatility is creating the perfect chance to load up on tech and the broad market at a discount. I want to hear from you. What dip level are you targeting for VGT or SPY? Drop your price targets in the comments below. If this analysis helped you out, give this video a like, subscribe for daily updates, and hit that notification bell so you don't miss a thing. I'll see you all tomorrow. Stay sharp and trade smart. Good morning, traders, and welcome to your market update for January 20th, 2026. It's a wild session out there. So let's break down what's moving the markets and how you should be positioned. First up, the S&P 500. It closed Friday pretty much flat at 6,940. So far in early 2026, we're up about 1%. Now, remember, this comes after a massive 17 to 19% rally in 2025. So a little consolidation here is healthy and expected. The big story, however, is the VIX, the fear gauge. It has spiked into the 19 to 20 range, way up from the mid-teens where it's been living. What's driving this fear? A mix of geopolitical noise, uncertainty around the Fed's next move, and renewed threats of tariffs. When the VIX spikes, it means volatility is back on the menu. But while fear is rising in stocks, another asset is absolutely exploding. Gold has smashed through all-time records, hitting a staggering $4,700 an ounce, even touching $4,733. That's a 1-2-3% jump just recently, and it continues the massive 72% rally we saw building through 2025. This is a classic safe haven rush. Investors are pouring into gold to protect against inflation worries, the ongoing theme of de-dollarization, and general global tensions. Speaking of the dollar, the DXY has slipped again, now trading around 98.4. This continued weakness is a tailwind for international stocks. Take a look at VIX, the total international stock ETF. It's holding firm above $78.60, with solid year-to-date gains as capital rotates out of the US and into overseas markets. Meanwhile, in the crypto space, Ethereum is consolidating in that $3,100 to $3,200 range after its recent bounce. It's holding its ground, which is a constructive sign. So what's the big picture here? The overall bullish structure for the market is still intact. We're still looking at a year-end target for the S&P 500 around 7,700. As forecasted by Tom Lee, he expects a very strong second half of the year, driven by the AI productivity boom and more clarity on economic policy. However, in the short term, get ready for more chop. This spike in the VIX signals we might be entering what Tom Lee calls the depression phase of his Joy Depression rally cycle. This means we could see a mid-year pullback of 15 to 20%. That would bring the S&P down to the 5,900 to 6,200 zone. This is crucial. These dips are buying opportunities, not a reason to panic sell. We saw this play out perfectly in 2025, where every bout of volatility created fantastic entry points for those who were patient. So, how should you allocate your portfolio right now to navigate this environment? First, international exposure through VIX should be a significant holding, around 35 to 40%. It's your hedge against a weak dollar and captures that rotational strength. With gold at record highs, an allocation to GLD of 20 to 25% is no longer just a hedge. It's a core defensive end momentum play. For your U.S. exposure, SPY or VU should be your core, making up 25 to 35% of your portfolio. Your strategy here is simple. Buy the dips aggressively. Tech, represented by VGT, is a slightly different story. We're underweight here at 10 to 20%. It's had a huge run, so we'll be patient and scale in on 5 to 10% pullbacks to capture the long-term AI rebound. For crypto, hold or add a small 5 to 10% position in Ethereum near support levels for that asymmetric upside potential. And finally, cash is king in a volatile market. Keep 15 to 20% in cash or short-term TI bills. Right now, 3-month TI bills are yielding around 3.5%, so your cash is working for you while you wait for opportunities. Here's your action plan. Hold your core positions. Do not panic sell. Your job is to buy weakness. Use a tiered approach. When VGT or SPY pulls back 3 to 5%, maybe you start a small position. If it drops 8 to 10%, you add more significantly. And if we get that 15% correction, you get aggressive. We are not hitting the sell button on our broad market positions unless the S&P decisively breaks below that key support zone around 6,000. And as always, stay nimble. Reassess your plan after big economic data drops or major news events. The bottom line is this: the markets are choppy, but the long-term bull is still alive and well. Gold and international stocks are the current stars. And this volatility is giving us the chance to load up on core U.S. tech and broad market ETFs at much better prices. What dip level are you targeting for VGT or SPY? Let me know in the comments below. If this analysis helped you, please hit that like button, subscribe for daily updates, and ring the bell so you never miss a beat. Thanks for watching. Stay sharp and trade smart. I'll see you tomorrow.